In today's episode, we're going to talk about the illegal practice of naked short selling that nearly brought the entire financial market to its knees in January of 2021 when GameStop made its explosive short squeeze. That short squeeze cost one hedge fund over $6.5 billion in losses, an almost unthinkable amount of money. What we have to realize is that GameStop was a black swan. It was an anomaly. How many times had these hedge funds won at this game before it finally caught up with them? Now, we'll probably never know. But to answer the question of how prevalent naked short selling is in today's markets, we're going to hear from a former Morgan Stanley investment banker who gives his raw take on this. All right, so now that you know that it's happening in today's market, let's go ahead and jump into the slide deck and let me help you better understand how naked short selling works. So first, I'll give you a crash course on short selling. Short selling is when you take a negative position on a stock, but it could also be on a futures contract. It could be on a Forex pair or cryptocurrency. It doesn't really matter. But you take a short position, which is a negative position, and you'll then profit as the price goes down. So let's just say, for instance, I'll just do an example here. Let's just say a stock is trading at $20 a share, and you want to short 1,000 shares. You short 1,000 shares. What's the most you can make on this position? Remember, you have to buy back these shares, and you want to buy back at a lower price, and you get to pocket the difference. So if you short 1,000 shares at $20, that's a $20,000 position. If you buy back the 1,000 shares at $15 a share, so 1,000 shares at $15 a share, you have to pay $15,000 to buy them back, right? So you get to pocket the difference between the two, which is $5,000. All right, that's easy. Now, the most you could make is if this went all the way to zero. If it went to zero or it went to like 1 cent, you could buy back the full 1,000 shares for 1 cent or whatever it is, $1, and you basically pocket the full $20,000 that you put into this trade. Now, this highlights the reality that the upside potential of short selling is relatively limited to the price going to zero. So when these big hedge funds were shorting GameStop at $10 a share, $8 a share, $6 a share, $5 a share, they were hoping and praying basically for imminent bankruptcy, that this thing was going to get delisted, bankrupt, and be trading under $1 a share. That's best case scenario. But what they didn't expect was the blow up that happened, because when it went from 5 to 10 to 20 to 40, 60, 80, 100, all of a sudden those losses start ballooning. I mean, think about this for a second. If they're short 10 million shares at $10 a share, by the time it goes to $20, they're already down 100 million bucks. By the time it goes to 40, they're down to 400 million. It's like it just gets bigger and bigger. And that's how they managed to lose $6 billion. And they needed a bailout because the loss was so big. All right, so to short a stock, you create a negative position, and it's worth noting you can lose an infinite amount of money if the price goes up and it keeps going higher. And you might think that doesn't happen. It never happens, but these are black swan events, and they can happen, and they do. In fact, I saw a stock once go from $20 a share to over $2,500. This was an unprecedented move. It was absolutely insane, but, it absolutely obliterated short sellers. So in order to create a short position, you have to borrow shares. And this is where we're going to get into the difference between naked short selling and legal short selling. So your broker is your intermediary. All right. So they are in the middle between you as the investment, the trader, the investor, and other clients that they have. So here's the way this works. You go to your broker and you say, hey, I see this stock. I think it's going to go down in price. I want to short 1,000 shares. And they say, okay, well, hold on. First, we've got to see whether or not we have any shares available. So a broker maintains an inventory of available shares. Now, if they have a stock where they've got a lot of clients who are holding positions, then the broker can go to those clients, borrow the shares that they're holding. Now, these are clients that are all invested. So they're holding positions to the long side. So what the broker does is it borrows 1,000 shares from this client and goes and lends them to you. They give you the 1,000 shares, and then you go into the open market and you press the sell button and you create that negative position. Now, you eventually have to cover your position, and you do that by buying back 1,000 shares at whatever the price is. Those shares go back to the broker and they repay the client that they borrowed the money from, they borrowed the shares from. So this is the practice of borrowing. In order to short a stock, you have to borrow it from someone else who already has a position. And the practice of illegal short selling is where this water here gets kind of muddied. So with a stock, for instance, that is many of their clients have shares of it, the broker would say it's ETB. ETB means easy to borrow. And they'll let you short and it's no problem. But when we had stocks like GameStop in January of 2021, it was hard to borrow. Why was GameStop hard to borrow during that time? It was hard to borrow because everyone who was holding a position, their shares had already been lent out to other people who were shorting it. Some of the big institutional investment bankers were so confident that this stock was going to go bankrupt that they were letting everyone short it to the point where there were no more shares available. So then what happens if some big investment banker or big hedge fund goes to the banker and says, hey, I want to short 1 million shares of GameStop? What does the investment banker do? Now they're in a pickle because they want your business. Now, this is not you and me, but they want the business of this hedge fund. And so they came up with this little idea to press a button to override. So before I get into the override button, it's important to understand that GameStop had also an unprecedented level of short interest. So if you have a stock, let's just say, for instance, we'll keep using GameStop. So GME, it had about 50 million shares available to trade, and that was the entire float in 2021. So 2021, the float was about 50 million shares. Float refers to the number of shares available to trade. So this meant that all of the people out there that own shares, the most shares that anyone could own was the full 50 million. And of course, the ownership was split among hundreds of thousands, if not millions of different individual investors. So when people said they wanted to short GameStop, in theory, the most that they could short would be the full 50 million shares, right? They would have to borrow from each one of these people that were currently holding. But what we know is that GameStop had 140% short interest. How did the short interest exceed the total float? There's a couple ways that this happened. One way that it happens is the broker says, oh, you want to borrow 1 million shares. So they lend you the 1 million shares and you go sell it on the market. So you now sell those shares to someone who buys it. And let's say they're at broker number 2. So that person buys 1 million shares and their broker number 2 says, oh, I can lend out your shares to my other client over here. This client borrows the shares and then sells them into the market to broker number 3, a trader at broker number 3, who then says, oh, I'm going to hold this, but another client there says, I want to short it. And all of a sudden, you've got short interest of 140%, which is, it shouldn't even be possible, but it happened. So short interest got crazy high, and GameStop shares became extremely hard to borrow because no brokers could find shares available. They had people that were asking, but they couldn't find the shares because all of the shares were already spoken for. So what did they do? Well, they created a little bit of a loophole. And the loophole is what's called essentially naked short selling. So a naked short is when the broker gives you, let's just say they gave you the full 50 million shares, and they say, all right, here's the shares. We're going to figure out who we're going to borrow them from later. All right, so the broker says, here's your shares, and we're going to figure out where we'll get them, we'll figure it out. And so they actually created what was called the F1 button. The F1 button, what it did was it would pop up a little window, and the banker would type something in. They would say they had reason to believe they would find the shares. In other words, it was like they were letting people borrow the shares, and they just kind of said, we think we have them somewhere. We just can't find them right now, but we're going to find them. So we're going to just give this person the shares so they can take the trade. It was a little override button. And in 2016, Goldman Sachs paid a $15 million payment to regulators to settle allegations about this F3 button. It was actually F3, not F1. So to the extent that it continues to happen today, as we heard from this Morgan Stanley former banker, it's clear that it does. In fact, there's 32 enforcement actions here that were against different investment banks for this abusive and illegal naked short selling practice. Merrill Lynch, Goldman Sachs, UBS, Morgan Stanley, Interactive Brokers. I mean, you go down the list. It's like all of these big banks are on here. And I think the thing to me is that none of these fines are meaningful. These aren't meaningful amounts of money, especially when you have firms that are making hundreds of millions, if not billions of dollars on this practice. And you also have to think about the actual companies that are victims of naked short selling. You think about the companies, their shareholders, their employees, investors, and traders like you and I. Because what naked short selling does is it essentially allows more selling than is natural. So let's just say, for instance, the broker uses the F3 key. I was wrong there. The F3 key, my mistake. And lets this one person short 50 million shares. And let's say another broker, another one of these investment bankers says, oh, I have reason to believe I can find these shares too. And they let someone else borrow and short 50 million shares. Let's just say these are big numbers, but let's just say for the sake of argument. Suddenly now you have an imbalance between supply and demand, where they've created essentially fake shares, but they're allowed to be sold on the open market. And all of that selling creates real selling pressure.
And the bank did not care. The client will send you an order electronically. All you do is you click on the order, you go to execute, it'll pull up a little box, you type in anything you want, and you just hit OK.
So then all of a sudden you get this flood of selling, which creates unnatural selling pressure, which pushes these stocks to levels that wouldn't have been achievable if it weren't for this practice. To the extent that this practice is still happening today, it's hard for us to know as retail traders because we're not on, the other side of the fence. We don't know exactly what's going on with these investment bankers, right? We're not on the inside. But what we know is that the motivation is to make money. Right. And so in the past, we know that they've found ways to sort of find loopholes and skirt the rules in order to make money. Now, that's a generalization. It's not going to be true for every bank, of course, but there are some that have done it more than others. So regulators have created a little bit of a system to try to track naked short selling. And one is the failures to deliver. Failures to deliver is when essentially these trades settle. So when the trade settles, you need to be able to finally tie back to, where did these shares come from? And that's on the broker. And so if they are unable to settle the trade because they can't find those orders, it doesn't undo the trade, but it's listed as failure to deliver. And stocks that have high numbers of failure to deliver can go on a special list. So this can be a way to track or attempt to track possible illegal and abusive naked short selling in the market. So it's called Regulation Show. It's called the Reg Show list. And it's a set of rules designed to regulate short selling. Reg Show, regulate short selling. And it's designed to prevent naked short selling. So a stock will be placed on the Reg Show list if for 5 consecutive settlement days, failure to deliver exceeds 10,000 shares. And then this list is basically a list of stocks that are flagged for closer inspection by regulators. So GameStop, of course, was on the Reg Show list, right? Along with many other meme stocks that had high degrees of short interest. Now, it's worth noting that the regulations do include a closeout requirement, which is that if a position fails to deliver at the clearing firm when the position is settled, that the position then has to be closed. But it doesn't change the fact that in the interim, the stock was exposed to this unnecessarily high level of selling. Now, in the case of GameStop was on the Reg Show list and showed $359 million. $359 million of shares that failed to deliver, right? More than 2 million shares failed to deliver at the peak of the so-called mania, as Bloomberg states. So what do you think? Is naked short selling bad? I think it is, because it essentially allows a version of the market where the true balance between supply and demand gets completely thrown off, because you can create extra shares. Now, you wouldn't be able to do that to the buy side, but you can somehow do it to the short side with this practice of naked short selling. So it can at least create a huge disconnect between the true book value of a company and its correct market cap and its actual trading prices. So it's unfair and it's illegal, and it feels like it's a practice that it allows deep pocket institutional traders to kind of, cheat the system so they can make more money. Basically printing more shares to sell so they can be more profitable. And as we saw with GameStop, it actually created widespread market risk. Now, of course, there was just one hedge fund that lost $6.5 billion or whatever it was. But DTCC, which is used for clearing trades, they reportedly waived $9.7 billion of collateral deposit requirements on January 28th, 2021. And they said that because it was to prevent widespread systemic risk to the financial system that would have resulted from large institutions defaulting on their obligations. In other words, short sellers became too big to fail, and they got a bailout. So at the peak of the squeeze, because of these collateral obligations, many brokers, including Robinhood and several others, simply removed the buy button. They didn't allow people to continue to trade. And once again, that's like changing the rules of the game. Changing the rules in the game and all of a sudden removing the buyers from the equation allowed short sellers to regain control of the stock. And on that day, GameStop fell by 75%. And obviously, that's not fair. Now, what we also know is that options trading amplified the volatility of GameStop. And so you've got Citadel, you've got Wolverine, you've got a lot of these large options market makers. And with options trading, the options market it is complex. And so for people that are new to options or don't understand them, options are a derivative. They derive their value based on the value of something else. So for instance, with GameStop, we have, as we do with many large cap and mid cap companies, we have an options chain that has calls and puts. And so when you look at the calls and the puts, they're based on different strike prices. So you had $10 and they go up in tighter increments, but I'm just going to do, for example, 30. We'll just go to 50. We'll go to 75. We'll go to 100. We'll go to 200. And what's crazy is that people were buying calls on GameStop at the $75, $100, $200 strike prices when it was still trading at so much lower than that. And so the market makers were like, wow, people want to buy the right to buy GameStop at $100 a share. This is easy money. We will sell them as many contracts that they want to buy. And so all of a sudden, you have 100,000 contracts, for instance, that market makers sell on the open market for a stupid amount of money. Stupid in the sense that maybe it was only $1 per contract. So they don't even make that much money. But then all of a sudden, when the stock squeezes up to $300 a share, every single one of these strike prices are in the money. When they're in the money, what that means is that the firm that wrote these are now obligated to buy shares to cover the exercise if this person actually chooses to exercise their position. So 100,000 contracts is equal to 10 million shares. All of a sudden, you're the equivalent of being short 10 million shares. And this thing's going up 100 points at a time. Hits $500 a share, they're down 5 billion. It keeps going higher and higher and higher. So options absolutely amplified it. And some people think that there was a gamma squeeze on GameStop. Now, regulators disagreed with that. They didn't think that there was a gamma squeeze. I'm not even sure if they really think that naked short selling was a contributing factor to the squeeze on GameStop. But, the report from them, it's hard to know. In any case, what we do know is that the price went absolutely insane, and there were market makers and hedge funds that lost billions of dollars. And these option contracts amplified that volatility. So what would have happened if GameStop had gone to $1,000 a share, right? Could it have been that stock that I saw that went up to $2,500 a share? Then what? Now, many people think back about the Volkswagen short squeeze that happened, it was more than a decade ago now, but it was at the time really legendary. And it was just completely like exploded. And so the fact is, these things can happen. And the biggest risk is when you have either hedge funds or investment bankers. Really, it's the banks that we worry about, not individual hedge funds. If a hedge fund blows up, it's a hedge fund taking too much risk. But it's when you're worrying about a bank. When you're worrying about the bank, and of course, if they have hedge funds that are defaulting on their obligations to them, then that does put the bank at risk. So we worry about banks. When you think about the biggest recessions, the biggest depressions in this economy, it's when the bank fails. When the bank fails, that's when things get real. That's when it gets really bad, when the banks need a bailout. Now, GameStop didn't force, a bailout from the government to the banks, as we know. But at the same time, part of that was because, the buy button was taken away. And, the rules of the game were kind of changed in the middle of a trade. So the fact is, naked short selling allows the price of a stock to become incredibly disconnected from the true market value of the company. It's an illegal practice. It's an unfair practice, but it continues to happen in the market. So what we learned from GameStop was that high levels of short interest attract attention. There are now, you can do these data searches where you're just searching for stocks that have the highest level of short interest. Because when GameStop made its big move, about 10 other stocks that had short interest in excess of 85, 90% also started to squeeze. Because suddenly retail traders were like, whoa, short interest basically shows us where the whales are, and there's nothing they can do about it. Think about this for a second. This is called days to cover. So days to cover. So let's say you've got a stock that has 50 million shares short. And let's just say the float is, 50 million shares. All right. So they've got a 100% short interest, which is ridiculous. But let's just say, for instance, that stock is only trading an average of 5 million shares a day. How many days would it take to cover that entire position? Based on that volume, it would take 10 days. It would take 10 days of nonstop buying. So what happens if in 3 days, an army of retail traders come in and they send the price up, 200%? These guys are stuck. Now, granted, when a stock goes up 200%, it's going to be on much higher than average volume, but still, they're going to be stuck. And it's going to be difficult, if not impossible, to unwind a position this large without some serious damage. And that's exactly what happened with GameStop. So the problem here for these institutional investors is the reported short interest. So following the epic short squeeze in 2021, these brokers are now trying to figure out how can we short stocks without people knowing that we're short. Because once they tip their hand and the market can see the percentage of the float that's short, suddenly at a moment's notice, you can have a bull raid where all these bullish long bias traders come in, they start buying up the stock, and then that forces short covering. So we now are seeing more purchases in derivatives, and we've got options trading, which are a derivative, and we also have equity swaps, which are a derivative. And both of these are being used as vehicles to benefit and profit from the decline of a stock while trying to skirt the regulatory reporting, which creates this short interest list. So, they're just always going to try to stay one step ahead of us. And I think for us as retail traders, if we were able to know which stocks had the highest percentage of short interest, we would definitely want to pay attention to them because these are stocks that are candidates for epic short squeezes. But at this point, I think the reported short interest is becoming a irrelevant data point because deep pocket big money is finding different ways to get short without flipping off those triggers that other people would pick up on. So at this point right now, one of the things that I do pay attention to is the percentage of institutional ownership that a stock has. When a stock has high levels of institutional ownership, I kind of at this point assume that that's a playground I shouldn't be really messing around with. And so another thing that I would say is that I always try to pay attention to where these big whales are in the market, because as a little fish, I'm just kind of riding in the wake that they create. So rather than trying to trade against these whales, I try to trade in the same direction as them. So if we see a stock that's just getting pounded, it's getting just, slammed lower and lower and lower, I'm not usually going to try to buy it and guess that it's going to reverse. It's going to make an incredible recovery. I just stay out of the way. And I look at stocks that are trending higher and that big money is behind. You look at the Teslas of 2021 or the Nvidias of today. These are the stocks that I'm more likely to trade just in the direction of the trend. Don't fight the trend. So I hope you found this episode interesting. If you did, hit that thumbs up, subscribe to the channel, and I'll see you for the next upload real soon.